Hello, everybody. Welcome, as always, to Friday and to the Rebel Income Insights live stream. I'm excited to be here, as always, and to have an opportunity to be here with all of you and start talking about what's going on in the markets, especially as they relate to some of the trades that we've been following in on the Rebel Income system. Just by way of a little bit of shameless self promotion and just to try to help, the YouTube algorithm out here. Just a couple of things really quickly. If you like this content, and good morning, Barry. Thank you for the comment. That was actually number one. If you have a comment or a question for some of the things we're going to be talking about today, please feel free to use the chat area. I'm going to be paying attention to that throughout the course of the live stream, and we'll try to incorporate those as they come in. Jay, hello. Welcome as well. Also, if you like this video, please do go ahead and like it. If the content is appealing to you, that helps the YouTube algorithm see that the video is getting engagement as well as views. Also, thank you for the one who did. That's awesome. Um, Also, as we're going through some of the things we're going to be talking about today, you can also uh, uh, you can also do live reactions over in the chat area. There's a little heart icon, and if you open that up, you can click on some of the different things to a little some of the emoticons there to react uh, in the moment. So those are also always fun. So a couple of different ways you can do that. Gib, hello as well. Welcome everybody. I am really excited, as always, to be here and to have the opportunity to interact with all of you. Um, it's Halloween, first of all. So happy Halloween, and I hope everybody has some fun plans. We got to go trunk or treating last night to a neighborhood trunk or treat with my grandkids, and that was a lot of fun. It's it's a lot of fun to watch an 18-month-old little boy start to figure out that all he has to do is look cute, hold up his bucket, and people will give him candy. When that light goes on, all of a sudden he becomes all about business. And that was a lot of fun to see. Okay, well, personal notes aside, let's go ahead and dive in. As always, it is Expiration Friday. That means that we're going to be talking about some of the so we're going to be going over our latest trades and positions and kind of seeing what their status is. Um, Really quickly, I need to update. I actually need to update my log. I did not update it from last week, so give me just a second here. Need to look up Nike. And okay, 24th closing price was 69.11. When this expired. Okay. All right. So we'll be now that my track record is updated. Um, we'll be going through the open positions and seeing how they stand and seeing what kind of decisions and updates may need to be made with some of those, if there's some things that we can do, or just simply consider what different possibilities or alternatives are available. Um, let's go ahead and get started. Dive right in with the put sale that expires today. That is on Conagra Brands, stock symbol CAG. This is a trade I placed a couple of weeks ago, selling the $18 strike price and bringing in a premium of 44 cents per share for a little under 2.5% overall yield on this. Selling three contracts, that means that the total reserve obligation that I have to meet for this is 18 times 300 is $5,400. So that sounds like a few more contracts than I usually sell, but that is a function of the lower price. The position sizing is still very, very much within the ranges of what I've been trying to do lately in terms of being conservative with the amount of exposure I'm putting to each and every position new trade that I place. I'm trying to be very conservative and generally trying to stay below 2% total exposure relative to the value of my account. That is very conservative. That means that while the yield per trade may still be good, on a total dollar amount, that movement is going to be very gradual in terms of the way that it increases my account. But that's okay. Right now, I feel like that's something that is more important than trying to maximize the per dollar amount brought in terms of overall income. I want to be very conservative with my position sizes. That allows me not only to be a little bit more diversified and place more trades, but it also limits the exposure on each one and makes the overall risk on each one a little bit easier to think about. You need to remember that whenever we're selling a put option, it besides the income that we're bringing in, there is an obligation associated with that put sale. With Conagra, this means that since I sold the $18 strike price, the buyer of these options has the ability to force me to buy the stock at 18 at any point before expiration. Now, expiration is today, so we'll see where the stock is at, but I have to be aware of that potential obligation, and that's why that $5,400 reserve requirement becomes important. Okay, so with that in mind, let's go to Conagra really quickly, and we can see at the open here it's a little bit lower and plumbing new lows, in fact, relative to where it was when I placed the trade. We had the stock roughly around here, a little bit above 18 when I placed the put sale, and expected to have pretty solid support here. And we're seeing just in the last few days where that support has broken down, and that is creating the assignment here. So Barry, as much as seems that CAG keeps dipping, excuse me, may be more prudent to split the put sales as it falls. We know it's a good company and probably not trying to catch a falling knife. Yeah. And so that's, again, trying to stay conservative, right? Um, it- I think what you're talking about, Barry, is if my normal position size, maybe I sell 3 or 4 contracts here. Maybe one of the things that I could do is to cut that position size in half. So maybe I sell one, maybe 2 contracts, right? Initially, and if the stock continues to drop, maybe there's a point where then there's an opportunity to add another position. Thank you, Barry. Okay, making sure I had that right. And that's actually a really smart strategy. I appreciate that. We've got some of the people that in our group that do this actively. They'll call this tiering in or legging into a total position. The idea is really simple. If you think about what the total position size you're willing to take is, let's say that in the case of Conagra, it was $10,000. For me, 5,400 is right around correct. But in fact, let's go ahead and round up for the simplicity of math, and let's say that the total number we're looking at and willing to consider is $11,000. That's a little more than double what mine is. That would mean that you could sell up to 6 contracts. Okay. Well, that would roughly double the total exposure from I'm probably in the 1.5% range right now. That would increase it to about 3%. Again, still conservative, which is nice, but then you can make that trade, make the position even a little more conservative. And this is a smart thing to think about, especially we're taking a very contrarian approach because we're dealing with stocks that are in very extended downward trends. Now that creates really good opportunities to buy stocks at really good valuation levels, but it also means that sometimes we're going to buy stocks that are going to continue to fall. They're going to continue these downward trends. Just because I'm selling 18 doesn't mean that 18 is going to be the bottom. Sometimes it is, sometimes it isn't. And if you're concerned that maybe it isn't, maybe there is some additional risk that it could continue to fall, maybe instead of selling the full 6 contracts, maybe you pull that back, maybe you sell 2. What that gives you is the ability to leg in later if the stock drops, say maybe it's down at 15, maybe there's an opportunity to add another couple of contracts. Maybe if it later it's down at 12, then you can add another couple of contracts until you're finally at that maximum size that you're willing to accept. Um, that's kind of smart. It's a little bit of it's kind of the reverse of the normal dollar cost averaging idea, where you're consistently putting a certain amount into a position. But what you're doing is you're kind of averaging your cost lower as the stock moves lower, and that means that when the reversal comes, and look, downward trends are can be hard to pay attention to and follow. But here's the other thing: remember that all trends are finite, and when you're talking about a good company like Conagra, there is going to be a point where the market is going to begin to recognize the value that exists in this company. And when that happens, the stock is going to start to lift back up again. So if you've been taking this legging in approach that Barry got me talking about, um, that means that you're actually going to be able to you will probably be able to turn a profit on the trade more quickly than somebody like me, for example, where in most cases I set my maximum position size at the very beginning with the initial trade, and then I simply am willing to ride this out if I end up taking a little bit longer, a few months, then that's fine. I get to bring in some dividends from those. Now, just a note here on this dividend, this one declared the dividend yesterday. So dividend date was the 30th of October. Um, I have not been assigned yet, but unless the stock moves above 18 at the close here, I am going to be assigned. I am not going to get this dividend. Needed to be a shareholder of record yesterday to qualify for that. I recognized that when I placed the put sale. So okay, so this is Conagra. Let's just go ahead and take a look really quickly at the options. And if you're of the mindset that you're using the income from put sales as a um, way to try to take advantage of short-term swings, and there are a lot of traders that do this. If this is just a variation on a swing trading method, then you're probably already out of this trade. And in those cases, this is what I call a more active rolling approach to the system. What that means is that if the stock is moving against you and there's a risk that you're going to be assigned, remember with American style options, you can be assigned anytime up to the expiration date that the stock is below the strike price you're selling. It doesn't mean you will. In most cases, the majority of assignments take place on the day of expiration. But if the stock is showing a lot of bearish momentum and it's dropped significantly below the strike price you're selling, you can be assigned before the expiration date. That means that in all likelihood, the majority of traders that are working with these kinds of strategies will probably have already bought this option back. They would have done a buy to close order and simply gotten out of the trade. In my case, if I wanted to avoid the assignment, I just said this is not going to be worth it to me. Here's my $18 strike price. I would need to pay the asking price for this contract, which is $1.20 right now. Let's take a look really quickly at the details of the contract. Yeah. I might be able to try to split the difference here between the bid and ask, considering the distance of the spread And the trading range here, maybe I could go in for something like 80 to 85 cents, and that might get filled. In fact, there's a good chance that I think it would be, but I would probably need to wait a little bit for it. So if I simply don't want to wait, I want to try to move as quickly as possible and make sure that I close out the obligation. Could just simply pay the asking price. That does mean if I were to do this, that I would have to absorb a loss of 76 cents per share. On 3 contracts, again, that's $300, 300 shares, excuse me. So that means that I'd be taking a total loss of $228 on the total position. Okay. Uh, that doesn't sound great, but it's also less than about, well, let's do the math. Let's be precise. Yeah, it's a little bit less than 5% of the total reserve obligation. So that's actually pretty manageable, as far as strictly from a money management standpoint. And so that would actually be not a terrible thing to do, just from the standpoint of trying to minimize losses, especially if you, for whatever reason, maybe you don't want to buy, maybe you don't want to own Conagra. I use put selling as a gateway to stock ownership. I'm actively selling options against stocks I would like to own. That's why I don't avoid these assignments, but certainly not everybody's going to be doing the same thing. Okay, so that's Conagra. If anybody else is working with this, has some other numbers that they want to share, maybe you've managed the trade a little bit differently, just have a different view on it. Feel free to share it as always. Okay, the next trade up is actually the put sell that we placed today, or this not today, but this week, excuse me, and that's on Delta Airlines, selling the $58 strike price. Excuse me. The price on this was $1.50 that I was able to bring in terms of premium, a little over 2.5% for a little over 1 week. So this expires next Friday. Let's keep that $58 price in mind as we take a look at where this stands 2 days after I placed the put sale. Okay, similar fashion to Conagris is a little bit below the strike price that I sold, which is 58 right here. So we're seeing a little, possibly a break below support. This isn't so far yet, nor has it not had, nor has it held so long that I would be willing to totally call this a breakdown. But it does look like it could be, and so this creates some interesting opportunities for analysis. Just a couple days later, Barry is already in at CAG at 25 and 1950. So holding off on any new trades right now. Fair enough. Fair enough. That means your average cost is a little over 22. So, and you sold Delta at 57. So you're still a little bit above water. I'm a little bit underwater. Thanks, Jay. Appreciate that. Jay's a little bit ahead of me, so I'm going to give you a tick mark. Being able to get in a little bit lower, and and Barry's getting the dividend. You're right on Conagra. You own shares already, so I'm going to give you 2 tick marks because you took 2 assignments on it, right? So you get the dividend, you get a multiple of the dividend. So that's nice. And again, that's the reason that if you don't mind the idea of owning these stocks, that's the advantage. That one of the advantages that stock ownership gives you is the passive income from those dividends. So that's awesome. Okay, so Delta is already breaking down a little bit. This could hold. We've really got support anywhere between the stock's current price. Even now, it's holding up just a little bit above 57, possibly all the way down to 56. And reinvesting that dividend. Yeah, you bet. And that's kind of the great thing about dividends is that it gives you the ability to decide what you want to do with that. It's cash in your account, just like the premiums that we're bringing in from the put sales, right? These are cash. You can use these for living expenses if you want. You can reinvest them, whatever your preference is. I like to use them for reinvestment because it makes it easier to grow the account. And primarily right now, that's one of the objectives I'm going for is long-term growth. So I'm right with you, Barry. Thank you. So this could have support. I don't expect this to actually break down too much below 57. We'll see. I could be wrong, but we're already just 2 days into the trade, and let's see what that means in terms of what we could manage. Remember, for Delta here, my reference point is my $1.50 premium that I brought in. So let's take a look at what the stock is doing now. And see if that gives us some things to work with. All right, let's go to next week. And here's the $58 put option. There's the bid, sorry. And I wanted this. So if I wanted to buy this back right now, I'd have to pay $2.07. That would mean absorbing a loss here of 57 cents per share. I only sold one contract in this case, so that would be $57 to minimize that loss a little bit more. I'm not too afraid of this, as I mentioned before. I don't avoid taking assignments on these. I like Delta at this price. Uh, Jay likes it at 57, and that's awesome. So I'm not really of a mindset right now where I feel like I need to try to minimize this. But if you wanted to, there's certainly enough activity going on, plenty of open interest. The fact that there is volume in this contract today means that if you didn't want to monkey around with this, even if you just went at $1.97, which has been the last trade on this here. Even if you wanted to go at that level, you could. It's interesting. The thing that is interesting here is that the intrinsic value of the option, this is essentially what is there in terms of uh, primarily time, as well as the difference between the strike price and the stock's current price. And right now, this is really showing next to no time value. It's all wrapped up in the price here in terms of intrinsic value, but the ask is quite a bit higher. So there's a lot of extra implied volatility going on this one. So uh, that's interesting considering it's recently passed its earnings report. So that's one of the reasons I was working with the put sale is the extra implied volatility was creating some outsized premiums, but it also means that there's going to be a little bit more volatility in the stock that you need to be willing to deal with. Either way, I don't pull those dividends out. I either use them in my account to reinvest or to invest in other stocks, and that's an awesome way to use dividends. Jay says you got 82 cents on your put for DAL. Jay, what for the 57? Again, you went a little bit lower than I went for a little bit more premium. I got a little bit more greedy. Sometimes that happens, right? You're looking for the balance between the premium your premium you want versus the price you're willing to pay. Uh, Jay is taking a little bit lower one, and but as a result, you made your trade a little bit more conservative. That's good. That's not a bad thing. That's a really good thing. And still, you're getting about 1.5%. So in premium for 7 days, 9 days, excuse me. Let's just put that in perspective. Here's 82 cents divided by 57. Oops. 0.87 divided by 50. Sorry, I'm still not getting my numbers right. 82.82 divided by 57. There we go. 1.43%. May not sound like a whole lot, but remember, that's for 9 days. So 1.43, let's remember that one. 365 divided by 9 days. That means you may be able to place up to 40 trades with the same capital, potentially. This is an idealized number, but this is a practical way to think about the yields that we're bringing in with these put sales. So 40 times 1.43, 1.43, 57% on an annualized basis. That's the advantage of just working with short-term options. This is why, when we have opportunities, practical opportunities to roll forward, ahead, up, down, whatever the case may be, sometimes those rolling opportunities are really advantageous. This is another example of that, just because we have a very short-term contract we're working with, creates the opportunity for more trades. More trades, higher trading frequency equals greater compounding, which is great. My trade is a little bit higher price, but looks like I'm going to be taking the assignment. That's also okay, because, as this is where we'll have opportunities to bring in the dividends, and hopefully opportunities to uh, generate more covered call trades if the stock stabilizes after taking an assignment. That's what I'm hoping with Conagra. Um, um, we've still got a week to expiration on Delta, so that doesn't mean that just because the stock is at 57.23 now, doesn't mean that I'm going to take an assignment. Just means that right now the stock's a little bit underwater. So we'll see what happens here. It is going to be interesting, not only to see where it finishes the day today, but also what happens after the weekend, where we have 3 days of time decay between Friday, Saturday, Sunday. Then when the market opens on Monday, see how that impacts implied volatility as well as the other premiums here, and depending on what the stock is doing. So there may be opportunities to manage this along the way. Okay, so that's Delta. We also have a covered call that came up on Schlumberger. This is, well, I guess I should say now, they renamed themselves SLB Limited. Um, the SLB is a stock that I've held for a few months, and along the way been able to use for covered calls on multiple occasions. It's been really actually very productive, as I've been able to sell covered calls and not be not be called out, excuse me, which has meant that I can just keep the income generation machine going. This latest, I was assigned at 35, and the stock was showing some momentum, picking up some momentum on the upside. So I was able to sell the $37 strike price. Previous covered calls, I sold 36. Here's 36 here, 36 again. And here's the initial assignment, beginning of August at 35. So this has actually been very productive and mostly staying above the strike price that I was assigned and showing some strength now. I was able to bring in 78 cents on this. I do only have 100 shares. So I sold one contract, brought in $78 here in premium. But again, we talk about dividends being a nice income source, but this is the other reason I really like taking. I like owning these stocks is this opportunity for the passive income from the dividends, and also sometimes repeated opportunities for covered call trades. Now, not every stock that I take an assignment on gives me this opportunity, but I get a fair number of them. And these covered call trades become really productive, not only because of the income they're bringing in here, but these premiums, 78 cents, 70 cents here, 81 cents here, as well as the 65 from the initial put sale. All of these premiums that are brought in, as I can count them as income, they also can count against the overall cost in the stock. And so in reality, if I add all of these together, let's just do 0.65. Scroll up here a little bit so I get the rest of these. Okay. $67, 81. That was nice. Here's 70 cents. And then this latest was 78. So here's 5 income generating trades just since August on this one. Let's do the math. Let's figure that out. So 0.65 plus 0.67 plus 0.81 plus 0.7, 70 cents plus 78. So I've been able to generate $3.61 in income against this trade, against these 100 shares that I've been holding since the beginning of August. All right. So let's divide that by 35 really quickly, 361. That's the income I've been able to generate for holding this stock for the last 3 months, 10.31%. That's not even counting the dividend it's not counting this dividend, which was 19 cents. So that would add a little bit more to this. 361 plus, I'm going to call it 19. So 380 is the total income. That means in literal terms, that my actual cost is around 31.20 on Schlumberger. That's really attractive. And here's the stock chart. As of right now, it's still got to give me a little bit more lift to call me out at 37. But if I do get called out, then that adds another $2 of income between 35 and 37 on top of everything else that I've been able to do. So this is another one that has been really, really productive. Barry has a $36 call expiring. So same one as me, Barry. That's which is awesome. You're actually sorry. You're at 36. I'm at 37. So you're already in position where you could be called out, and you probably have a better chance of being called out than I do. And one of the reasons I say that is where the stock is at. Look at the way that it's held the last few days, right around the 200-day moving average, which is right around 36. That's providing resistance right now for the stock. I need to reset my chart view. There we go. That's providing resistance for the stock here. And so it may not get to 37. If it doesn't get to 37, that's okay. I don't mind that. I'll have opportunities to keep selling more covered calls. But the way that it's picked up momentum here, it had been a little bit depressed September to October. Got down all the way down here a little bit below 32, but it's been picking up some nice momentum lately, and it's probably technically a little bit due for a correction. It would not surprise me at all to see the stock start to trace back a little bit towards the 20-day moving average, and then maybe rebound again. But we'll see. It could also simply kind of hover somewhere between 36 and 37 for a little while. We don't know. This 200-day moving average could become new support. So we'll see what's happening. If it does become new support, that's a good indication that this longer term downward trend is about to reverse, which would be nice. That would be good news. Okay, let's move on to some of the others here. Um, Going to the third week of November, which is where the rest of these trades land. Have a put sale on Eastman Chemical. So going back into the materials sector a little bit here, I have a couple of positions already in this sector, so I want to be kind of conservative about trying to take on new stocks in this one. But Eastman, very high value stock at the strike price that I sold on the 22nd at $55, bringing in a little under $2. This is a 1 month trade. Part of the reason for the longer duration on this one is just because EMM does not have weekly options. So the only practical expiration that was available when I placed the trade was the third week of November. So let's go over here to EMN really quickly. And let's remember here, selling the $55 strike, and we're still a couple of weeks to expiration. Well, excuse me, about 3 weeks to expiration. But here's the $55 strike price. I brought in $1.05 on this. Remember, we're always selling at the bid, buying at the ask. So if I wanted to buy this back right now, really, there's no reason to. I would actually have to absorb a little bit of a loss on this. That's really not practical. There's no reason to do that, especially with the stock still holding nicely above 55. The other part of this too, there's 55 is actually nowhere near the current support level here, which is down at the low end around. I'm going to go ahead and call this about 59. Um, and so 55 is all the way down here. So why did I go with 55? Well, that's also a function of what was available. This is a stock with $5 increments between contracts. Normally, I would like to try to get a little bit closer to the stock's current price when I can, but that's also not possible with EMN. So working with $5 increments makes it a little bit more interesting in terms of not only trying to decide what contract you're going to sell, but then later, if you take an assignment and you're looking for covered call trades, sometimes this $5 difference between available strike prices complicates the covered call question. Not going to lie. So we're gonna. It's going to be interesting to see how this one plays out. For now, it looks like this is working out okay, even with the stock's momentum here trailing trailing lower right now. We've really got this is a strong support level down here around 59. So if this holds up at all, then we'll be okay. It could even actually break down a little bit, and we still be in pretty good shape. For historical perspective here, it does break down here. We've got the stock hasn't been below this level since the beginning of the pandemic, and in fact, we've got to go back even further. Here we are, 2012, to really get back into these price ranges at all. So if we break down below 59, here's 57 in, well, 2016. So I use this as a benchmark there. If it breaks down below 59, we could see it drop down here into the $57 range, possibly. But these are multi-year low levels right now, which generally implies in the near term, when you start seeing these, this is one, this is a double bottom already, possibly the beginning of a triple bottom. I'll put a question mark there because we're just not sure. If this holds, this forms a third bottom here. This becomes a pretty high probability bullish reversal pattern. But what you would be looking for here is another pivot low down here around 59, and for the stock to start rallying. This level around 64 will then become really critical as resistance. And if we see a push above this, the likelihood that this longer term downward trend reverses begins to increase by quite a bit. All right. Any other thoughts on Eastman? Anybody else that's working with this one wants to share their numbers? Or even if you just decided to pass on the trade because you didn't like the way that the options contracts lined up, that's okay too. When you start working with stocks that have fewer contracts available, fewer expirations, only monthly as opposed to weekly, you do get some different logistics that you need to think about. So doesn't mean that there aren't useful trades there, but it doesn't mean that the analysis shifts a little bit. So for now, the interesting thing here is even with the distance between the buy and the ask, sometimes people will ask me if the trade that I placed maybe a week or even 2 weeks ago has already passed. The interesting thing about this is that when I placed my trade, there were 30 days to expiration. That was 9 days ago. Been in this one for just a little bit over a week, and the bid price here is actually above the bid price I brought in. I brought in $1.05, and now there's $1.10. So if you like the value proposition for Eastman, you don't mind the increments here, or the little bit more limited uh, options that are available. That's an interesting premium that's available for a 3 week trade, as opposed to the $1.05 I brought in for 4 weeks. Just saying. Not a recommendation to buy or sell, but always things to think about. Those are interesting. Okay. The other trades that I've got on deck right now, and it looks like we'll probably have some time to talk about some other things. So, if you have some stocks that you would like to highlight and mention for the group and bring to our attention, then feel free to do that. But the other ones are some covered calls from previous assignments that I took a couple of weeks ago on CTRA and on Skyworks. CTRA, I was assigned at 24, and I sold at 24.50 strike price on the 22nd, bringing in a little under 2%. This is a 30-day trade. And the stock had dipped down a little bit to start the week, and has been rallying just a little bit, but is still about $1.50 away from the 24.50 strike price that I sold, which was up here. I'm okay with that. This was my assignment price, so I'm a little bit underwater on this one. But we'll see what happens. There's still some time on this one. Get to wait and play this out, and it is coming up on earnings. So earnings announcement is going to be on Monday. That does introduce the possibility of some big movements the early part of next week. It's one of the reasons that implied volatility on the stocks and on its options has been a little bit higher, which is part of what created the opportunity to sell the covered call up here at 24.50. So we'll see what happens on this one. But right now, it's using the 20-day moving average as pretty strong support. Got that right around here, a little bit below 23.50, and it looks like it's forming the latest pivot low off of that level. We could see it try to rebound a little bit, again, depending on not only what these numbers are, but how the market perceives them. So that is going to be an open question to see how that shakes out at the beginning of the week. And really quickly on Skyworks, this one I was assigned at 75. And this is another one, again, implied volatility here, very high. I was able to sell the 77.50. That's right, baking in potentially a $2.50 capital gain. That doesn't happen for me very often. And bringing in $3.40. I was able to immediately lower my cost basis quite a bit between the $1.80 that I brought in on the put sale and the 340 I brought in on the covered call. Math wise, I'm doing pretty well here. $4 and wait a minute, that's not right. $5 is what it should be. $1 plus 340. There we go. 520. So if I subtract that from 75, my cost basis is below $70. So if I do get called out at 77.50, that'll be a very, very nice result on top of what I've already been able to do. So Um, we'll see where this one goes. Skyworks right now is above that price. It this spike right on the earnings date. This was the reason that implied volatility had been so high, and it's up at 79.42. So as of now, it looks like I will probably be called out. Because of that, there's really not a reason to try to buy the call back. And here's the reason. Some people say, well, why don't you buy the call back so you can try to take advantage of the rally? Well, that gets a little bit complicated. And part of the reason for that is because you have to pay more to buy the option back. In this case, 360. Um, that's interesting. I brought in 340, so I'd only actually lose about 20 cents to hang on to this and have the stock at 79. Actually, that might be an advantage. If you think that the stock is going to continue to rally, or if you just wanted to lock in a gain at 79, that's interesting. You'd make about $100 more. So, all right. Barry has three $41 calls, $41 calls on Intel, and you've been working with this one for a little bit and taking advantage of a nice rally here. And yeah, looks like these are going to expire today, as the stock's rallying, but it's been tracing back for the last few days, so you're still a little bit below 41 right now. It was above there until yesterday. Brought in 88 cents per contract, debating buying back and selling again. You really could. Let's take a look here. You very well might be able to do that. $41 call. My friend, 9 cents on the ask, you brought in 88. Hang on to 79 cents, right? If you bought that back, you could even just sell the $41 again or go to 41.50. Here's 2%, a little over 2% at 41.50 for 7 days. I miss my friend Joe. Because if Joe were in this, he would be screaming right now. He would absolutely be screaming right now. I can't make a specific recommendation here, but the math here, Barry, is pretty compelling. Hang on to 79 cents of your premium, right? That's a little under 90% of what you brought in premium from the original one. Turn around and sell 41.50. Give yourself a little bit more potential capital gain, or even, good heavens, if you wanted to sell the same one, $41, bring in $1.01. That's about 2.5% premium for 7 days. Working with the same strike price, my friend. I'm pretty sure Joe would be screaming. How about $1.21 at 40.50? I mean, you've got some choices. You got some interesting alternatives, and they're all kind of attractive, aren't they? There's not really a single bad choice here. Even if you wanted to go out to 72, this is a little under 2%, but then you're going in at 42 if you think the stock could start to rally again. So you've got some good, you've got some different choices, and all of them are attractive. Yeah, it is possible it could start trading back down. Yes, that is absolutely true. But again, we're talking about picking the low hanging fruit of the market. That fact that the stock could start trending back down, it could start retracing, considering considering the very accelerated pace of the stock's upward trend, this very well could begin to trace back down. And a retracement would probably be healthy. But even if you're talking about that, doesn't that make any of these even more interesting? This is the low hanging fruit. This is the stuff that is literally just sitting there waiting to be picked up, that too many people don't take advantage of. Pick one. Any one of these would taste great. Anyway, especially if you don't mind holding Intel for a little bit longer, and considering the one of the primary catalysts for this rally lately has been news that Nvidia has been has been investing in Intel and in their foundry services, and that's been giving the stock a lift. I expect that that news alone, not saying that's going to keep the pace of this upward trend going the same way, but even if the stock does retrace, I don't expect it to retrace very far. It may moderate this upward trend a little bit instead of going like this. You may see the stock come down a little bit and find a new support level. And so it may moderate the trend a little bit to something more like this that becomes a little bit more stable, a little bit more sustainable, I guess I should say. But even that's just speculation right now, considering the way that some of these tech stocks have been moving. It could consolidate, it could retrace, it could continue to move higher. There's no one. If we had a crystal ball, we would know which one of those was more likely. But right now, there's just no way to predict. So why not take advantage of the opportunity? I mean, this is immediate income. It's just sitting there right now. So that's really interesting. That's kind of compelling. So, Barry, thank you for sharing that. I really appreciate it. It's really useful. Just bought them back at 8 cents and sold them again at 4.41 for next week at $1.03. See, you even did better than the numbers we were looking at. So, man, that is awesome. This one is for that the covered call you just bought back, and this is for the one that you just resold. Just went out another week and just added another 2.5% to your account. So, I mean, that's amazing. That's awesome. All right. Everybody, thank you so much for your time as always. This is very, very much appreciated. This is one of the things I look forward to the most every week is this live stream. Please, I know many of you have shared this with friends. I just ask you to continue to do so. Try to continue to grow the Rebel In community as much as possible. If you have any questions between now and next week, please do reach out. My email address is rebelincomesystem@gmail.com. I do respond to each email as soon as I can. You can also reach out to me if you're on Discord or on Substack. Either way. Anyway, reach out and I will respond as soon as possible. Hope you have a great weekend. Enjoy the Halloween festivities. Hope that you have something fun planned. And we'll talk again next week. Thanks, everybody.